All right, good afternoon. My name is JD Bondurant. I'm the Director of the Tax Credit Program at Virginia Housing. I'd like to welcome everyone to the Investor Roundtable, State of the Market. We are very excited to have an all-star panel with us today that really represents a very diverse group of investors coming from really sort of three organizations that are really somewhat different, but all affordable housing investors. So we're very excited to hear from these folks who I'll be introducing here briefly. One thing I did want to do and was asked by by VHA was to give a brief update regarding the tax credit program. Hopefully many of you were able to catch our CEO's speech. Susan Dewey gave at 11:30. And I won't repeat a lot of that information, but what I do want to tell you is that in that she mentioned that next year would be a QAP update year for us. This year was to be a QAP update year, but obviously for reasons we're all painfully aware of, that did not happen. The plan is to move forward with updates in the coming year. And we will also continue to, administer our 9% allocation, competitive allocation round, and we always kickstart that in January. The plan is to continue to do that on schedule this year. And in fact, what I would like for folks to know is that our kickoff meeting will be Thursday, January the 7th, 2021. It'll be from 10 until noon. It will be a virtual meeting, I'm sorry to say, and will likely be the only meeting. We will be recording it and likely replaying it for folks. If you're aware, we normally travel around the state and do 3 or 4 of these types of meetings so that we can engage with folks. In this case, we will likely just do the one on the 7th. That registration is already up on our website, and I would by all means encourage folks to log on and go ahead and register. That helps us. It will be a WebEx meeting, and in that we will talk about the coming 9% round. One thing I can tell you, without there having been many or any QAP changes, the round won't differ greatly from last year or the prior year. So I think it's fair to say that this will be pretty much a steady, competitive round that very much resembles prior rounds. There may be a few tweaks around the edges, things that might be updated and included in the manual, but I would have to make the argument that right now, even those changes would be very, very limited given where we've been. So with that, I'd like to also say that throughout this next hour, if you have questions, we will be fielding questions. I'm going to try and keep an eye on the incoming text box. So if there's questions you'd like to have either me or one of the panelists address, please submit those, and we will do our best to see what we can do in response. So with that, I'd like to move to introduce our panel. First, we have Steve Smith, who's the Senior Vice President and Equity Relationship Manager for Truist. We have Ann Connor, who is the President of Public Finance and Community Investment with Town Bank. And we have Chris Sterling, who's the Vice President and COO of VCDC. As I mentioned before, these three organizations really do represent kind of a broad spectrum of the investors, from a very large bank to a smaller bank and a nonprofit syndicator. So I think these are panelists that most all of you would probably recognize and know from our work in affordable housing in Virginia. And at this point, what I'm going to do is turn the program over to Steve and then Ann and Chris and ask them to each give us sort of a general market update as they see it from their organization. And, so with that in mind, turn this over to you, Steve. You're on mute. I do that all the time.
Never fails. Can you hear me okay?
We can.
Good. Well, thanks for the opportunity to be here. The good news is each year we do a panel like this, and it's sort of like a moment in time. Where is the market and how are we doing? And right now, it seems like the market is in a really good place. Deals are getting done. We're not hearing of deals that are floating around looking for capital that are not finding it. So I think that there's an equilibrium or possibly even a little bit more capital than deals out there. So that's a really good place for the market to be generally. When you drill down a little bit, though, you might see that the market found an equilibrium at a lower price than last year, price per credit. And so that's a little bit of a pain point for developers. But again, deals are getting done. I think that with the availability of soft funds, particularly in Virginia, and reach funds and soft funds in a lot of the local municipalities, things are pretty good. So pricing might be down a little bit, I don't know, 3 cents just on average, but it's a really good thing for all of us that the market is performing and deals are finding equity. Ann or Chris, you want to go?
Sure. Good morning, everyone. I'm glad to be with you today. I think I agree with Steve's comments. We have seen some softening in prices. We are different than Truist, and as JD pointed out, certainly a far smaller organization. So we are primarily focused on Virginia and North Carolina, the footprint where our actual banking operation takes place. We have affiliate operations, our insurance company, mortgage company, asset management company, all of those affiliates that operate from Pennsylvania to Florida. But we really focus on Virginia and North Carolina for our investment portfolio. And we have seen some softening this year, but like Steve, I see deals getting done. And we see construction, some minor issues with construction delays and some pricing fluctuations, particularly price of lumber obviously sort of spiked in the past few months, seems to have come down a little bit. But overall, the developers with which town works have had good success in securing capital, moving forward with construction, and ultimately, of course, as is always the case, there's been little issue with filling the developments with qualified tenants. So we have been very active this year and already have a pretty substantial pipeline developed for next year. So a good market all in all. Chris?
Hey, thanks. We're based in Virginia, nonprofit syndicator based in Virginia. We primarily assemble multi-investor funds. We've very much appreciated the investment of the two organizations on this call with me today, in addition to others. We're typically working to finish one fund while we're assembling another one, and normally have about 8 to 14 investments in each fund, kind of depending on project size. I echo what we've just said here, that there's pretty good strength in the market. Ours is a sort of a long-term view on a pipeline. We typically have partners we're working with to assemble project concepts or indicate our interest on a project, and then it may take 12 months or 18 months to close on a project. So our pipeline is typically formed early, and we typically are not in a position to bid on projects as they take shape later. In some ways, that is helpful because we're taking a long view on some of that. But yeah, what everyone said here thus far is that there's seemingly pretty good strength. There have been some interruptions. We'll talk about this in the course of the conversation this afternoon. Some impacts right at the time that the state, Virginia, shut down. A couple of projects we were involved with that were single building, elderly focused properties where construction halted. It didn't resume later. It doesn't mean that everything is roses. Once they can, there was delays in some of this, but it seems that developers and properties recovered and are, trying to make progress, but bearing in mind some of the risks that come with where we are right now.
Okay, thanks. So that's very good news from an allocating agency perspective, and I'm sure a number of developers that are watching as well, that the market is in a good place, and we found some equilibrium. And I guess I'll even take lower pricing post-election this time than the last time, because the lower pricing last time was pretty brutal. So I'm assuming we won't have that to deal with. I will go to a couple of the comments about the deals getting done. And I will say, at least from the Housing Authority's perspective, that is one area where we've really dug in deep and tried to make a very strong commitment. I think the tone was set early with our leadership, our CEO, and also the rental managing director of our rental program, Art Owen, along with Susan and the other leadership team members. We're pretty clear that they wanted continuity as best we could through this process in the tax credit program. They wanted, accommodation, and by that I mean, extensions where we could provide them to help deals get done. And then the thing that's been repeated internally with our organization over and over and over is communication. And so we have very much tried to kind of honor those items through this process, and hopefully, I know I've written a number of comfort letters for syndicators and investors relative to extensions and extending dates. The last thing we at the Housing Authority want to happen is for any failure of deals. I mean, Ann, you spoke of the pipeline, and I'd like to hear more about all of your pipelines in terms of what you see coming and what we can anticipate in the upcoming rounds, whether they're 9% or 4% deals, new construction or preservation.
Well, our pipeline, and certainly you're aware of this, JD, we've been seeing a lot of 9-4 deals, and we continue to see developments that are based on a 9-4 combo, and that's attractive to us. Now, we focus primarily on new construction. We have done some rehabilitation, but primarily new construction, both senior and multifamily. But the 9-4s are generally multifamily projects. But pipeline has been solid as we look toward the new year. Now, of course, as I mentioned earlier, we're not going to be investing at a level that will move the needle as much as a Truist or even a VCDC in any given fund. But and we continue, as Chris mentioned, to invest in both multi-investor funds with VCDC and KHAC, since those are in our markets, and then doing direct investments, and as I said, just seeing a lot of 9-4 type projects coming forward that seem to be the best of both worlds, so to speak.
JD, one point that I wanted to make is, if you kind of step back and look at where we came, we had everything stopped in March, and we took a pause. We kind of stepped back and said, okay, what are we going to do? And then probably around June, we started back up. And we really, at the time, our developers tend to be really strong to begin with, but we have put a lot more focus on the developer strength. And I know we'll get into a little bit about the specific COVID underwriting, but I think the most important thing now is not the deal type or necessarily the location. I mean, that is important, but we really have done a deep dive on the sponsors. And the good news is, I mean, we all come back to this when we have these blips in the market, and we all kind of look at each other and say, wow, great, the fundamentals really made a difference. Well, of course they do, but the good news is that we have really strong fundamentals. We have strong developers. And as we've done kind of the deep dive on portfolios and balance sheets and, you know, the projects, it really has proven that we do have great fundamentals. We have good underwriting in this industry. And that really has shown through in a time when deals and portfolios have been really stressed by collections and, you know, a lot of challenges that we have here. So we've been spending a lot more emphasis and a lot more focus on the underwriting of the sponsor and really understanding their situation. The deals, I mean, like Ann said, I love 9-4 combos. We're doing rehabs even during this time. We're doing new construction, so it's more about the sponsor.
So our partners are mostly community-based organizations, or ones that have a strong connection to a particular community, and a lot of what is coming from pipeline is driven by what they're undertaking. So we're not redlining, if you will. A rehabilitation project is being particularly risky. It's sort of how do you make that project work the best it can if it's a rehab project or new construction. Certainly there's comfort in the strength of the sponsor, but as we might touch on in this conversation, to really engage communities, you know, one thing we've done for years is to try to provide support for even community-based organizations that don't have a lot of experience, and to try to find a way to, even in the face of there being challenges with some of those organizations, finding ways to, you know, to get projects done, things that would not get done otherwise, that where the product is not matched in the marketplace. So I think the one place where we might try to be a little work on ameliorating what might be AHIC underwriting guidelines would be in community-based organizations that are tackling something really unique and interesting and impactful, but may lack, you know, $10 million on the balance sheet and you know, 16 different projects in their pipeline. I mean, we'd like to find a way to overcome that, and we're not by ourselves on that. It would be in collaboration with the other important parts of Virginia's network. And I know, JD, maybe we're talking about this in a second, but some of these programs that emerged from Virginia Housing and DHCD and others, local governments, in response to COVID, are also things that have been really helpful in making some of these impactful projects happen. You know, flexible resources and you know, good support networks for capacity building and so forth.
Yeah, I think that's a very good point and a pretty interesting topic in terms of flexible resources and what do those look like moving forward, and how do you get those in your deals. You know, we've talked a little bit about everything from, you know, in our pre-planning call, timing, getting deals placed in service, whether or not folks need extensions, whether they can get the deal across the finish line, which can be very challenging. And then in the end, is it, you know, are the deals still hold? Do they need additional credits? Do they need additional financing given the way the year has gone? Again, we've remained really committed to trying to work with folks almost on a deal by deal basis. And I think it's fair to say that is something I hope everyone will see from us in the Housing Authority, is a desire, and this goes to the communication portion. You know, we're not in a lot of face-to-face meetings, but there's a ton of communication going on every day in either phone calls or WebEx meetings to assess where deals are and try to get them over the finish line. And there are a number of deals that we have 8609 applications in on, and I can tell you that we are likely not going to go through a traditional final inspection process, but feel like we can still get to the end and get 8609s issued. You know, we've got 8 or 9 deals identified right now. Between now and the end of the year, we'll be reaching out to the owners But we know we've got another 20 or so coming in the first couple of months in January, February, March, that would need to also be addressed. And I bring this up because I know we have a lot of folks watching, and to the extent we can work with you on an individual basis to get to the end, that's going to be important that we do that. We don't want people to take credit adjusters. We don't want deals to not get done. We want to get the 8609s issued. And I think we have some creative solutions for ways to do that, but they will vary on a deal by deal sort of basis. And you've each talked about capacity with the organizations you work with, and I think that's another area that we too are trying to be very conscientious, and there are obviously development entities that have far greater capacity, and some with, we'll say, less capacity, and particularly in stressed times. Are you guys within your organizations focusing on those sort of varying entities, and there anything there that we can do to assist you with that on the groups that might be struggling?
Well, I'll jump in. We have found the VHDA to be extremely supportive and communicative on all the deals where there have been any minor issues, and I can't think of a single one of our investments that has had any major challenges, notwithstanding the major challenge presented by COVID. But certainly, we stay in constant communication with the developers and understand what their protocols are and their processes for ensuring that infections don't spread and that they're being as safe and keeping their residents as safe as possible. But that it goes back to Steve's comment earlier. Our developers are very strong, very experienced, affordable developers that have the financial strength and capacity to ensure that our partnerships have the resources needed to maintain the existing developments and to build the new ones and get those leased up. So strength of development team is critically important, particularly given the challenge of COVID. And I respect and appreciate the role that VCD plays in ensuring that those unique projects for organizations that may not have the experience or the super deep pockets that some other perhaps for-profit developers or developers that have been doing this for a very long time. But all in all, we look very closely at the development partner. And as a smaller organization, we are not looking at every deal that's being built or rehabbed in Virginia or North Carolina. We are generally working with developers that have a long relationship with town, that are long-term members of the that have financial services that, in addition to tax credit equity investment that we may make, we see a larger relationship, and we know those developers really, really well. And so we have great confidence in moving forward with either rehabs or new construction with any of those developers. But we have found VHDA, and perhaps it's because of the relationship that the developer has with VHDA, to be very supportive, very communicative, and very accommodating when there are situations that require the authorities' attention.
So JD, just to kind of follow on that thread a little bit, it would seem that some of the developers that have projects that have kind of been stalled in some part of the process, whether they're awaiting financing decisions or final construction numbers and so forth, certainly even ones that have a lot of resources have a lot of pre-development money tied up in projects that haven't moved ahead. So I think the idea is, I'm not going to speak for, I see a whole list of 101 attendees on this call here, people that probably can speak for themselves. I think the initial response in COVID was how do we offer a forbearance product and do it in a way where you're, targeting it to the most distressed properties, the ones that are really showing reduced collections and tapping into operating reserves. I think, DHCD's response, the state's response in offering some subsidy is a tremendous help in this process. I think now maybe, we can't predict when we're going to get shot in the arm at the CVS. Maybe that'll be soon, but the idea that what might come is just how do we resume some level of progress on this? I think that's happening, and I think construction lenders are underwriting, decisions are being made about permanent financing and all of that. But maybe there's some elements where some of the folks that are attendees here have ideas about things that might be able to move things ahead, so they can stop some of these stalled projects and regain some of their held capital. I think it's 2 shots in the arm at the
Two
CVS.
shots in the arm? Okay.
Shots,
Yeah, that's what I think it is too. So, when we had our first meeting, I said, hey, can anyone think of anything that's not COVID related? And the chuckles kind of went around the horn because it all seems to be COVID related. But let's talk a little bit about that. I mean, I can tell you the protocols that we have in place from our compliance side of the shop really is not doing compliance on-site visits or audits. Our construction control staff, I think effective today, actually will not be on site unless it's for a non-occupied unit. So anything that's got folks in it, so we're going to be sort of very cautiously moving forward. If you won credits in the 9% round and had a rehab deal, we've just sent you your carry forward, and in that we basically have asked you to return a relocation plan that is COVID specific. So with that in mind, if we could just kind of hear from each of you sort of what direction you or your organizations are moving or have been. We're well into this, so there are a lot of things you've probably already done to address COVID and be well positioned moving into the new year.
I can start on that one, JD. I mean, obviously, COVID is a big deal, really big deal, and it's been a big deal for a long time. But it's been great to see how people have adapted. So when this first came out, I mean, acquisition rehabs were almost off the table. You just didn't investors didn't want to touch them. Developers didn't really know what to do. And now I see those moving forward. We're closing one this month, now that we're in December. It's an acquisition rehab, and it just requires a really thoughtful relocation plan. It requires more time in the schedule for relocation. And what we're not seeing is what we would refer to as an in-place rehab, where maybe the workers are in during the day and then back out, and the tenants are at a hospitality suite and then back in. Those are not being done, and we would not do those right now. But if you're clearing out whole buildings or sections of building or floors or stacks, maybe several the same water lines in a section of building, that can be done, and that is being done. And that's really a function of people kind of saying, okay, how can we do this? And so people are figuring out a way. So ACK rehabs are not necessarily off the table. I know there's been a lot of sensitivity to senior rehabs. I would say the same thing. I mean, you need to be extra thoughtful about how you're relocating seniors and making sure that they are comfortable with the plan. And like you said earlier, JD, communicate. But I've heard of investors saying no just across the board on those, but I don't think that's true of all investors. It's not true of us. And so it's really, how can we figure out how to get these done? Whereas in the beginning, it might have been, nope, we're not doing that. Now it's more like, okay, I think we can do that under these set of conditions.
So you mentioned acquisition rehabs. You know, one thing that I feel like, unless you've really followed the industry, and by that I mean, you know, the data flow within the industry, or attend a lot of NCSHA conferences, you may or may not have been aware of this, but in recent years, the 4% production has really begun outpacing the 9% in terms of units produced. Interestingly enough, that trend has been the same here in Virginia. And for the last 3 years, we've averaged probably over 34% deals a year. And before that, you know, it was maybe 6, maybe 8 on a really, really good year, maybe 10 deals. So, you know, that trend has been sort of mirrored here within the Commonwealth. And just to your point, I think there was some real nervousness because those 4% deals do by and large tend to be more on the acquisition, rehab, you know, renovation. So, you know, that's something that I think we're glad to see, or at least glad to hear, you know, that those may be back on the table in the spring. Now, you bring up a point I would like to highlight for any listeners out there. If you clear out a building or a stack of units, when you get those done, if you can call us before you lease them and have our construction folks, you know, go out and sign off and approve the construction, we're going to be in a much better shape, much better, you know, situation of getting you your 8609 at the end of the day. So I kind of appreciate you bringing that up, because that's definitely something we're trying to focus on and encourage people to do. So any concern, you know, the 4% rates are, while the volume's gone up, the rate is about as low as it's been. Any concerns there?
Well, I would say I don't know that there's a concern, because when you put your deal together, you either have enough capital or you don't. So we don't really start and then wonder where the rate's going. We kind of know the deal works at a 3.08 or whatever it is, or it doesn't. And as far as the 4% fix, I would say the same thing. Like, we're not really holding out hope that it's coming. If it comes, that's great. And we have upward adjuster provisions in the documents that would allow for, you know, the 4% rate to be the rate. But, you know, the deal has to work on today's rate, and it either does or it doesn't. And I think if we got the 4% fix, that's great for everybody. But until we do, we don't have it.
So just most of the projects we have under pipeline right now are 9% projects. We've got a handful of 4% ones. I know this within our time frame here, we're talking a little bit about stress testing, not to bring it back to COVID, but just the idea of, you know, if you're kind of punching holes in the analysis you're doing with respect to additional vacancy or reduced collections, however you want to spin it. For the properties that are more debt reliant, there's less tolerance for those properties to have that kind of hiccup. So I think that's maybe the risk with, you know, a heavier loaded 4% project load coming out of Virginia Housing. And you probably can't subsidize every property there with, you know, $10 million of spark funding to make it work and to smooth out the edges, you know. So I think that's maybe the saving grace with some of the nines is having a little bit more cushion on some elements of that. And again, I think the availability of soft sources, particularly, you know, Housing Trust Fund resources, been really helpful and well timed, given the challenges properties are going through now.
Yeah, I think I would, you know, we keep hearing at the federal level that we have a chance that it's going to fix at 4%. We haven't seen it yet. I'll tell you what's of greater concern for me at this point, because we underwrite based on the deal with rates where they are now, and I think they're about as low as they could possibly be. Not to say that they can't go lower, but the greater concern for me at this point is federal stimulus that will do something about extending unemployment benefits for the 20 or 25 million people, or however many it is. It's a huge number that will expire the day after Christmas. And so obviously the first and most critical component of any financial statement is the top line revenue. And if we see a significant drop off in the ability of our residents to pay their monthly rent, then we're going to see a whole lot more significant problems than I anticipate seeing up front as we underwrite deals that are at the the 308 or 310 or wherever it is right now. So I am keeping very close eye on the federal stimulus talks. I think I saw another headline this morning saying there was a bipartisan group in Congress that were working on about a $950 billion deal. I didn't have a chance to read the article, so I don't know what was contained within it, but that's a tremendous concern. And the stimulus that passed back in the spring, I think, kept a lot of our residents afloat, and that extended unemployment. And so to the extent that that dries up the day after Christmas and isn't replaced, especially with the expectation of the growth in cases across the country of the virus, that's a real concern. That's a real concern for us in terms of financial stability of existing projects and the ability to fill new projects in the coming year that are placed in service.
It appeared that bipartisan proposal included some relief there, but not at the level that there was originally. So, but something may be much better than nothing at this point.
Yeah, and it should be noted, and I won't go into the details, but I know Virginia Housing has been instrumental in the RMRP, the Rental Mortgage Relief Program, and we have processed tens of thousands of applications for rent relief and paying back rents. And, that's ongoing. So I know many are aware of that program. You should, if you're not aware, you should also know that we've dedicated staff from across the authority to that too. I mean, I don't know the exact figure, but we have folks even in the tax credit department that have dedicated time to that internally. So that is an all hands on effort at Virginia Housing, and I'm sure will continue to be until those applications get processed. I did want to back up just a little bit on the 4% conversation, just because something we've seen in the recent months, or even the last year or two, really a couple of 4% new construction deals, and that's not something that we typically have seen. As you all know, we have had the 9-4 hybrids. I could point to a session probably on its own of outcomes, intended and unintended outcomes of that program. One of those has been an increase in folks, figuring out the 4% and making that work. But I will say we've been pretty pleasantly surprised to see 4% new construction, and some of that even gravitating up 95 towards Northern Virginia. So I would just ask, do any of you have anything in your portfolio or anything in your pipeline that you think mirrors that? Or are you seeing folks go in that direction? Because that's a pretty positive step.
Yeah, I agree, JD. We've been a part of 3 of those in Virginia, and it's been great. I've always thought that bond deals require a basis boost, a lot of soft money, or some subsidy, and maybe a fourth is kind of the 9% basis allocation, which helps. But it is great to see that coming together with 4% new construction. And I think in those cases, the ones that I'm aware of, there was a lot of soft money from a bunch of different sources. So it's, you know, it's not rocket science, but those sources right now are available and people are taking advantage of them.
Okay, so I will pivot a little bit here. We've talked a little about construction, obviously a lot, because that's been a pretty big factor. Delays and you know, I think the earlier session this morning, Danushka's presentation, she talked about lumber and some very, I think some intuitive things I think a lot of people know, maybe haven't seen it in graphic form. Some things I think were probably ahas, but you know, that sort of construction market, labor market, you know, how are those affecting your deals, or are they?
Well, I will say it has not affected us to the point where it's a problem, but we have heard delays in the system, sort of from the GC level getting materials. And so there may be delays that are not as apparent to the outside. We're not being delayed 3 months because we can't get lumber, but I know it's a lot more work for folks to schedule and make sure those materials are there. And from time to time, we've heard about different products, like lumber's the one that is the most current shortage. But, you know, I think that the GCs that are the primary GCs for most affordable housing deals in this region are doing enough volume that they're able to get those supplies.
Yeah, I agree. We haven't, you know, minor issues here and there, particularly early in the year, but haven't seen any major construction delays as a result of inability to get supplies. And I think that's back to the point that we were talking about earlier. Ensuring that you have the right developer partner is critical. Also, ensuring that developer has the right general contractor is critical in an underwriting process, and ensuring that that general contractor can meet its obligations throughout the process. That is a critical underwriting consideration for us. And most, again, sort of back to the relationship issue, most of our developers are working with contractors with whom we either have a relationship or are very comfortable with the general contractor, and so size and financial strength and volume matter in this case, and I think the general contractor has to be underwritten as carefully as the developer in a lot of cases, particularly in today's environment.
We've seen JD, sorry, we've seen a couple of impacts like that. And I guess the information we're getting even from experienced general contractors is the general contractor is not making the appliances. So you gotta wait for that supply to be available, and there's no amount of hoping you can do to make that available. And then again, they're not milling the lumber either. So that's another thing. And I guess that building that into our underwriting is something that I'm sure we're all doing. We have some other investors we've been working with that look for certain types of stress testing, making assumptions about utilizing construction period liquidity for cost overruns, or making assumptions about 3 or 6 month or 9 month delays in construction. Certainly, there's no way to make a rosy scenario, and we're kind of imagining a worst case scenario. That's a component of this. One other thing, sort of, kind of a procedural thing we've encountered is the idea to a couple of investors are pushing in this direction. Subcontractor buyout. I took a scan through this attendee list and I didn't see, it wasn't obvious to me who was with a contractor, but the idea that not only is the general contractor signing a construction contract, but that they've got some level of, some deep level of subcontractor contract in hand at the time that they're starting construction. The idea that the developer is not going to be left holding the bag on accelerating costs, from subcontractors that maybe a contractor didn't pin down. Now, I'm sure a subcontractor, even an experienced one, only has so many controls over material availability and so forth. But the idea that we're pushing this out to get better detail and maybe better solutions at the subcontractor level is a helpful thing. I know that we're kind of getting at that with VHDA wanting before all of this contractor level cost certification.
Mhm.
In a way, it may be a way to anticipate that process now by getting up, more granularity on what the subcontractor detail is that the contractor is carrying. I know it probably annoys contractors to have additional people asking questions at this point, but if it sets the stage for an easier contractor cost certification later, maybe that's helpful.
Yeah, I would agree. And that's definitely something we should talk some more about, Chris. By all means, we're trying to identify costs as much as possible on the front end. And we actually have, cost limits. We don't have a lot of trouble with folks meeting cost limits, but where we do, they seem to be very big issues. And that's something that you can count on being updated in the coming year as the program. We update those annually, but that'll be part of the QAP conversation as well. Trying to figure out, to protect the program, what sort of costs are there. You both sort of touched on both Ann's comments and Chris, yours with the GC, but talking about relationships and existing relationships, that is something that we have, another trend that we've seen in the program. We're trying to kind of get our head wrapped around, and one is on the 9%, it's still oversubscribed. We still obviously get out all the 9%, credits each year, but there has been a declining number of applications and a declining number of sort of discrete applicants. And on the flip side, you've got the 4% where there's been an increasing number of applications and applicants. And oftentimes those applicants involve people that have never done business in Virginia. We have seen on some occasions everyone involved with the deal being an unknown entity, down to the GC, and I guess I would just ask, are any of you guys sort of soliciting new folks in your program? Or are you pretty much just sticking with the existing relationships, or how is that working? And just if anybody wants to speak to that.
Well, I will say unequivocally, we are relationship investors. And so we are not looking for partners who come from outside of Virginia or North Carolina. We are generally sticking with the relationships that we have. Now, certainly there are developers with whom we do not have a relationship that we would like to, but as a rule, we stick very closely with our existing portfolio of partners.
JD, I would say that when we do have a developer who's new to us, we take a long time to get to know them. So if they call up and say, I've got a deal, we generally don't do that deal, but we maybe use that as a start to get to know people. It's a little harder in your position because they're actually applying for a deal and saying, I've done this elsewhere and I want to develop here. So it's a little more challenging, but because we, like Ann said, because we put a lot of value on relationship, that takes time. So get to know them first and then enter into a deal.
And we're very much relationship oriented also. And as I mentioned at the outset, we're normally not sitting around with a whole bunch of fund capacity waiting to find developers. It's usually a longer term combining of efforts to make that happen. That said, I think, if there was some outside party that was going to be doing the right thing in a community and it seemed to pass muster, I mean, we'd take a look at it, but it would be with an eye towards looking for the quality.
Okay. Again, I bring it up because, we've had some newcomers that have been wonderful additions to the program, both 9 and 4. And we've had some that have been very challenging just because we do things very differently in Virginia, as each state does. But particularly on our construction, our minimum design and construction requirements, things of that nature. Sometimes that's challenging if you're not used to what Virginia wants and the scope of what we're looking for in our deals. It might be a good time to mention that many of you know our manager of construction services, Sergio Gambale. His staff also we've had several additions over the last year, but since this meeting last year, 2 additional construction control officers added to his staff, as well as 2 new architects. So, and a number of those, additions I think are designed to help us with some of this increased volume, obviously on the rental side, but also we get great benefit from them on the tax credit side as well. We had a couple other topics, and I do want to throw out, we have the chat, so we're coming up on the end of the hour. If folks have some questions about things we haven't discussed, obviously there are many directions we could go here, but would be happy to try and answer those questions. So don't forget that's there.
It looked like a couple of comments came in while we were talking,
Yeah, and I will highlight, one was regarding cabinets and the loss of 2 months because they were being imported and sort of a recommitment to buying American cabinets where possible, I guess. And then the comment that it's hard for new folks to break into the tax credit program if they're not from Virginia in general. So new experience developer. We can't let Ryan have more than 1 question, so he got his first one. And that's moderator's choice, right? No, I'm just kidding. The one thing I will say, Susan also mentioned, we will be looking at large point categories. If anything in the program that's getting, 30, 40, 50 points, I think you can expect us to be revisiting, not that it'll cease to exist or it'll get changed, but it'll definitely be something we talk about in the QAP process. Developer experience is one of those items. It's very difficult to win without it. As she also noted, the 9-4 hybrids garner a lot of points in our program as well. Anything you all would like to
So
cover?
there was a question that just came up from Sunshine. It said 2021 will see significant new resources available for developers doing more energy efficient, affordable housing. Does this impact how Virginia housing and/or investors view the coming year?
Any panelists? I mean, I will say, we like to see that. We like to see additional funds. We like to see energy efficiency. In fact, I'll say we'd love to see it. I think there will be some energy efficiency topics that are seriously discussed in our QAP updates. And anything that could reduce the credit request is always welcome, just because the further we can stretch them, the better.
Agree to all that, JD. Love to see more resources there.
All right. I do have oh, I'm sorry, Chris, did I cut you off?
Oh, no problem. I agreed. Looks like Mr. Hoffman had a couple of questions too.
No questions from Eric Hoffman. Let's keep moving. There's stuff to get done here.
That's where I was going. All right.
It's,
So
it's densely written with whereases in it, I can see. And,
Yeah,
you know,
no questions, sir.
So one of Eric's questions, there has been an increased focus recently on preservation, which is intertwined with the advent of aggregators and concerns about both nonprofit exits under the right of first refusal and for-profit using options that allow for an inexpensive exit. Do you hear about this concern in the industry and in your organizations?
this has popped up in some recent closings, and I'm sorry, I was traveling yesterday and missed the afternoon session where this may have been talked about, but our disposition in our role is to be married to a property. We're not trying to do wrong by communities by trading out assets and getting out of things early. Ours, maybe to a fault, we've got things that are 22 years old and we own them. So we've got sort of a buy and hold strategy there. I think the idea that there's pressure in the marketplace where folks are coming in and maybe not having the best of intentions, we're certainly not trying to participate in that marketplace. I think it's not our resource. You know, we're an intermediary and we do the work of the investors that work in our funds. I think that there's an eye towards not shutting the door to, market opportunities, but there's not a demand among investors in our funds to being able to sell any interest at any time to anyone. I think the idea that, we position properties to have an opportunity for the conveyance of limited partner interests under the right circumstances and to the right people is, it seems as if there's a middle ground there we can all find where it's not a problem. I think steering clear of the bad actors is something we're very interested in.
There's a running list of bad actors out there, and we're trying to steer clear as well.
I agree. Same thing with us. We're including those in our partnership agreements now. We, and the list has grown, sadly. But we're buy and hold, again, relationship oriented. We are in it for the long run. We are definitely in it for the long run, and we haven't reached a point yet where we are ready to exit, because we only got into this business in a very small way in 2008, 2009. Since 2013, we've ramped up our activities substantially. So we haven't even we don't have a project in our portfolio that has reached the end of the compliance period at this point. So our intention is always to go into the deal and be there for the duration.
Sounds good. Well, thank you all. Thank you all. Oh, let's go with one more question. It says, how often do you see affordable housing development efforts promoted through the frame of ending homelessness? Is there more that can be done to tie these two issues together?
So,
I'm sorry.
yeah, I was just saying, from the allocators standpoint, we certainly see that, but it's typically, from specific groups maybe designed, like Virginia Supportive Housing to end homelessness. I think sort of an unspoken, underlying theme with any affordable housing, effort is to make sure someone is housed and avoids the pitfalls that could come their way, which could lead to homelessness. So I think there's both kind of a spoken and an unspoken effort there. But Chris, what were you going to say? But yeah, there's always much that can be done. I'm going to go back to Susan's comments earlier today about service enriched housing. That's That is something we haven't gone into in great length today, but certainly a lot of conversation at the national level going on there. And I do think that type of effort is very much at the core of this issue of ending and keeping folks from becoming homeless.
Well, thank you so much. You all have provided us with a lot of information. Thank you for sharing what you have experienced in your organizations. And so I just want to thank everybody for joining us for the first day. This is the wrap up of the first day. Thank you for bearing with us and all the technology. I am so grateful for all the attendees, all of the panelists. Thank you to Danushka for opening up this morning, along with the federal panel on housing. I'm sorry, Ryan Johnson just asked where the party was and I got a little sidetracked. There is no party unless you're partying with yourself, Ryan. But anyway, I hope that everybody has a great afternoon. I want to thank our sponsors again, and I'm going to go ahead and announce the current leaders for the game in the exhibit hall. So we have Diana Carter in first place. We have Palmer Ferguson in second and Rebecca King in third. So tomorrow there will be a new list of challenges in the exhibit hall. Tomorrow we are kicking off with the state and affordable housing part 2 with Eric Johnston, Willie Fobbs, and Pam Kestner from DHCD. And I would like to thank Susan again for joining us to let us know what Virginia Housing is up to. And for anybody who joined us for our awards, congratulations again to all of our VHA annual award recipients. So we will see you all tomorrow at 10. You can log into the same app and go to your agenda and join us there. If there's any questions in the meantime, feel free to email us at hcc2020@vahousingalliance.org. I hope you all have a great rest of your afternoon, and thank you all again.
Thanks, everyone.
Thank you.
Thanks.